All right, like I said, this is going to be recorded. Thank you guys all for joining us. I know it's Friday afternoon after the markets, long day, big bull rally today, but I appreciate you guys all taking the time out of your day to participate in this with us. So I'm going to be going back and forth with you guys on this. I see a lot of new names here, so I don't know if you guys are very familiar with how I work, but towards the end of this, when we kind of pull up the platform, I like a little bit of give and take. So, I want to hear from you guys what you guys are looking at, what you're concerned about, and try and work that in here. So, as much participation as you guys want to add really adds to the overall presentation, in my eyes anyway. I hope you guys get a lot out of it too. I'd like to answer your questions and see your angles on it to add a little bit of a third dimension to it, I guess, if you will. But this is a strategy for bear markets. Now, after today, the Bank of Japan raising the interest rate, or sorry, lowering to negative interest rates, some could say we aren't really looking at a bear market anymore. Well, that's yet to be seen. The overall global economies of scale are still pretty weak in my eyes, just from the economic data we've gotten out. So it still could be a very good time to start implementing these. Maybe after we get a bit of a rally and start getting a little overbought, but there's still even stocks out there that could work with this strategy. But before we get going, my name's Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you take control of your finances, manage your own risk, and most importantly, take control of your portfolios, you guys. That is really important. I don't know if you guys have been getting your statements lately, but most managed accounts are not doing very well. And at the end of the day, you guys could start taking control of your own finances and managing your own risk just as well as anyone else out there. Yeah, Nick's asking, what are negative interest rates? You pay the bank to hold your money. That is exactly correct. They don't want you to put your money in the bank. They want you out there spending it, trying to get people to use that money in other ways. One thing, what we noticed with the low interest rates here, corporations, that was the idea, is that they would get out there and spend on infrastructure, spend on other things rather than just holding their money in a bank account. But what they ended up doing was taking that money, leveraging themselves and buying their own stocks. Well, they were buying their own stocks, and that's really what created a lot of this upward movement in the overall indices, or in the overall equities, I should say. And, that creates another type of crisis, if you will, because they're buying stock on borrowed money, and that's never really a good thing in my eyes. Moving on, I've traded in most markets throughout my career. I've traded at the Chicago Board of Trade. I've traded stocks, currencies, commodities, equities, financial futures, and options on all of those markets and in all market conditions. I've been there and done that. Got to go over a little bit of disclaimers here just to make sure everything's clear. Any opinions, news, research, analysis, or other information provided by ProTrader Strategies or associate companies or employees is for general commentary and not to be constituted as investment advice or solicitation of any of the things that we talk about. I do have positions in some of the things that we talk about, you guys. I'm not trying to get you to jump on board with me. At the end of the day, I want to teach you guys how to swim. I don't want to swim for you, if that makes sense. And the bottom line is we're here to teach you this, so do your own homework. And please remember, past performance of any trading system or methodology is not necessarily indicative of future results. I'm sure you guys have all heard that before. But moving on, so this is creating synthetic short stock positions for bear markets, or if you're just bearish on the underlying. It doesn't really have to be for a bear market. If you saw that GoPro was way overvalued. I mean, they're one trick pony. They have one product for the most part, and they came out with a huge value or valuation when they IPO'd. Now, that would be a time that you could have shorted that, maybe even Fitbit or something along those lines. I'm going to come up with some examples of some stocks later on that I think are a little bit overbought or somewhat of a one trick pony that we might be able to short. But we'll get into that a little bit later. And I want to hear from you guys what stocks you guys think may be overbought or maybe overdone, and we'll go through that too. So some of the advantages of using synthetic short stock. And before I get into this, everybody clear on what shorting stock is? It's when you borrow stock and you are short it rather than just going out and buying stock to get long. So with options, we can create a synthetic short stock position, and we're going to use a lot less margin for one, but what we're trying to do is basically sell the stock before we own it. It has really the same risk as if you went out there and just bought a stock outright. You still have the risk of that going to negative, but nobody ever looks at it that way. At the end of the day, when you're shorting a stock, you're just doing the opposite of buying it. You just have a different mentality. When you're buying a stock, you're obviously thinking it's going to go up or you wouldn't have bought it. This is where you're going to sell a stock because you think it's overvalued and you think it's going to go down. Some of the advantages are you don't pay dividends. I said, you're going to use 50% less buying power reduction in your account. You don't need to wait for an uptick to short sell this, and you don't need to go out there and try and borrow the stocks. Sometimes stocks are hard to borrow and even none to borrow, so you might not be able to short those kind of stocks outright, but you can go into the options chain and build a short stock position and use 50% less buying power there. This is going to be great for, like I said, overbought stocks, or if you have a bearish assumption, bearish markets, to pairs trade. So if you wanted to get long Caterpillar and short Deere or something along those lines, or long Ford and short GM, you could do that with this type of situation. Or if you're long Ford in your account, you can do that. Hedging, if you just thought that the stock that you have is overbought and you wanted to sell it, but you didn't want to take on that tax implication because you've held it for so long, you could do this type of strategy in regard to that. Now you have capture upside. It would be almost like just selling that stock outright, but if it does go down, you'll be able to sell it at your synthetic short strike price. And for portfolio delta adjustment. Now this is pretty important because what happens to a lot of us is when we're buying stocks and putting this in our portfolio, we are delta long. And what delta long means is that you are long the market. Now, what happens when the market goes down? Well, tick for tick, you're losing money. So as an options trader, I'm very conscientious of my deltas in my overall portfolio. And that's something you guys really need to look at because the market does go up and down, and you need to have some negative deltas in your portfolios to take advantage of any type of pullback or something along those lines. So make sure you do become very aware of that. Sorry about that, guys. I don't know. All right, so moving on. So synthetic short stock, you're going to have the same risk as you would as if you just shorted the stock, but it's going to use 50% less buying power, like I've mentioned a few times, and it increases your return on capital. And some people may ask, how does that increase your return on capital? Well, if you're using less capital and you're getting the same I don't want to say increase, but for every dollar for dollar that you make on it, well, if you've used less capital for that dollar that you've made, then that increases your return on capital. Does that make sense to everybody? If I needed to use $5,000 in buying power and it goes down $1 versus if I only used $2,500 in buying power and it goes down $1, that's how you increase your return on capital, because you haven't used as much capital to get that same dollar increase in your portfolio. Excuse me. So building a synthetic short stock position is really pretty easy. You are selling an at-the-money call and you are buying an at-the-money put. Now, at what point do you pick that? Well, you know, you can use technical analysis. You can say, well, this is a support and resistance area on a Fibonacci that you can see where it's bumped up against several times and failed, and that's a place where you want to short it. That would be the strike location you would pick when it comes up to hit that technical area, or whenever you decided. You know, if you decided today, hey, I heard news, then you would go out there and hit the at the money. All right, so the risk profile on it, your max profit is achieved when the stock goes to zero. Okay, so it's going to be a dollar for dollar increase in your value of your portfolio for every dollar that underlying goes down. And you know, you don't have to just pick a stock. You could pick gold, GLD, silver, SLV, or something along those lines, and still short those if you were bearish that underlying there. But your max profit is achieved when it goes to zero. The thing to remember is that your max loss is infinite, because you know, stocks can go to the moon, right? That's the whole premise on buying a stock, is because that it can go straight up. Yeah, like can it be a Vanguard ETF? Quite possibly. You know, a lot of these things are going to depend on how much volume is out there. Like, I'm not going to pick necessarily a stock that isn't traded very often, something like AbbVie, because the bid ask on something like that, you know, is very wide. But most definitely you could pick a multitude of different types of ETFs. The big key is that there's a lot of players in there, and that the bid ask is tight. There's a lot of volume and open interest is always the rule I go by. Look for volume and open interest. If there's several thousand contracts being traded in that options chain, then the likelihood is there's a lot of players in there, and therefore the bid ask is going to be a little bit tighter, because every person in there is trying to outbid the other person to get in and or out of that position. Something like AbbVie is the only one that's coming to mind, because I was kind of looking at that one today. The bid ask on those is really wide for where the stock is trading. You know, it's not like an Amazon, where Amazon you would expect it to be a little bit wider just because it's a $500-600 stock, you know. So you know, you have to look at that. Make sure there's a lot of players in there, because when you're getting in and out of these positions, you have to make sure that you're not giving up too much edge to get in, and you're not giving too much edge to get out. So that's very important when trading options, you guys. It's you know, and it's kind of the same way with buying stocks. You know, if the bid ask on a stock is $5 wide, you know, you got to give up $5 to get in, got to give up $5 to get out. It's kind of that same mentality. If you've got to give up you know, a quarter to get in and a quarter to get out, all of your profits are going to be eaten up by getting in and out on that big scalp, if you will, is what we used to call it. And the break even is going to be the strike price that we choose, that at the money call and that at the money put, which are the same strike. And if you receive a credit for it, you're going to add that to your break even. And if you have to pay a debit, you have to subtract that to get your break even. Does that make sense to everybody? All right, good. All right, so let's just kind of, you guys go ahead and hit me up in the questions box on some stocks that you want me to look at, and we can try and look around some of your stocks that you have, and I'll see if it fits along the lines with some of my my parameters on this. Let's just look at Adobe, because I had it up earlier. So Adobe, as you can see, it's like a $90 stock, almost a $100 stock. The bid ask on this is pretty tight. It's inside of 10 cents. And during open market operations, it's even likely to be tighter than that. You can go up here, and this is what I'm talking about with the volume and open interest. And as you can see, there's not a ton of volume and open interest on these March contracts, but there is quite a few players in there. So this having, you know, several different strike prices that have different people trading in them, you have a pretty decent bid ask, you know, 10 cents on anything under, inside of 10 cents on any stock that's under $100 is usually my threshold to look at. You know, you can look at something like if you go to Apple, so Apple's pretty closely correlate or close to that strike price, or those the underlying is trading at $90, 97 here. And as you can see, even Apple, with all of this volume and open interest every single day, is still, you know, right around inside 10 cents. So they're pretty close to what the other would have. Got a couple of only slides. Are you guys seeing my platform now? Bruce says he's not seeing the charts, only the slides. Is this showing up right here? Steve, me too. No, oh, well, can you see my options chain? I don't have it. Let's see here. Let's see if I can do this. No slides. All right, let's see. So the platform, let's just do this. Give me 1 second here then. So I'll just hit escape on that for right now. You guys seeing my screen now? Or my, how about now? You guys got the charts now? Nick says yes. Everybody else seeing the chart now? I just got rid of the slides, I think. All right, so I skipped over a couple of them. I'm being asked, why would you want unlimited risk? Well, you know, unlimited risk, when you buy a stock outright, you could say, why, that's unlimited risk too, in a sense. I mean, it's unlimited to the point that it's going to go to zero. So this is just the inverse mentality of a buy and hold type of strategy. If you go out and buy a stock, say Apple, you know, there is a possibility this stock could go down in value. So you are taking on the same type of risk on this buy and hold strategy as you would, in a sense, doing this short sell strategy. You know, if you would have, you'd be a genius if you sold Apple up here on these triple tops here, knowing that it was overbought and made, you know, $40 to the downside. Okay, so wait, no chart slides only. Are you guys? Oh, sorry. So everybody's got the charts now, right? No charts? All right, let me try something. All right. Not sure why this isn't picking up, but let me try and do this screen to see if this is, oh, that's, okay. So, all right, hold on.
Hey, Eric, I'm going to break in real quick. I don't want to be on your recording, but...
Give me 1 second. Sorry, guys. How about now?
Yeah.
Got
okay,
it?
so,
You got the graph?
there you go.
My fault. All right. Sorry, I forgot to switch the screen on that. Anyway. Okay, so now that we got the charts back up, so the idea here is that, you know, on this Apple, if you would have shorted Apple, you know, you'd make a ton of money on it on the way down. So that's the idea of this, is something that's overbought. You know, you can make money when the market goes down, as opposed to just the buy and hold mentality of when it goes up. So the idea here is to create some negative deltas so that you can take advantage of a down movement in the market. So, and that's really important. And a lot of people miss that when they build a portfolio. They build a portfolio of stocks that they like, they get diversified. But the fact of the matter is you're beholden to the market always going up. So if the market comes down, what do? You essentially have created a situation where you have a lot of risk, and that risk is to the downside. That risk is that those stocks are going to be losing money. So it's it's a bit of a hard thing to explain because people always think the market's going to go up, but it doesn't. The market does go down, and you have to be prepared for that. You have to hedge. It's a hedge to your portfolio. And there's stocks out there that you guys probably don't like or you think that are overbought. So that's really important to look into when you're trading these type of things, or when you're taking advantage or you're taking control of your own portfolio. You need to make sure that you are protected to the downside as well. Does that make sense to people? Does that make sense to everybody? Okay. So, like I said, so you would go into the options chain, and I'm pretty bearish. I've been bearish. If you guys watch any of these market commentaries that I do daily throughout the week, I'm pretty bearish and been bearish on Apple for quite some time. So the reason being is because they just keep producing the same thing, and they put a new skin on it. The Apple Watch didn't do very well. And they're trying to do another Apple Watch, but they just keep taking that, the iPad and making it bigger, or they're making it smaller, but it's the same thing. And I don't see that being a very good business strategy going forward. They're great marketers. They just are struggling with innovation. And that I could see as a problem. Plus, funny story, my wife went to get an upgrade on her iPhone 6, or upgraded to the iPhone 6S or something, and they offered her a free iPhone. So my son got an iPhone. I mean, imagine that. Whoever thought that iPhone or Apple would be giving away free phones? And that's a bit scary, because that's usually an indication that there might be a chink in the armor. So that is something to look at. All right, so yes, this I'm getting blown up with questions and stuff, but do you do directionals and spreads with the options? Yes, I do, and I do a lot of directional trades. If you watch the daily market commentaries, I give the reason why I think there's a directionality to it. I also would look at something like this and say, it could be getting in a trend and getting into iron condors. So I do a lot of neutral strategies if I don't have a really strong opinion on it. But I'm a pretty opinionated person, if you guys have seen anything that I've done in media, but I'm pretty opinionated, and I'm not always right. I'm not perfect, but I like to take a stand and put my money where my mouth is. So this being a situation where I don't have a position in Apple right now, but I am looking to get short Apple anywhere if it comes up and tests this like $100 area. I don't think it's going to break through there, but this would be one that I am looking for it to come up here and to short again. So I've covered a lot of my shorts in the equities on the downside. And now I'm a little bit long deltas in my portfolio and trying to get back to a bit shorter deltas. So I'm slowly adding more short deltas to my portfolio. And if you watch the daily market commentaries, I talk about that all the time. So, and Nick's asking, this is a portfolio adjustment. At the end of the day, if you are long 20 different stocks in your portfolio, for every dollar those go down, you're losing a lot of money on the downside. So you have to, in my eyes, protect against any type of downside. Now, whether it's selling calls against those different stocks that you have in your portfolio, there's nothing wrong with that. What that does is it really lowers your overall cost basis on what you paid for it. So for instance, if you bought Apple at $100 and you started selling calls against that, then you're lowering your overall cost basis by selling that premium. And so if you paid $100, you sold some calls for $1, then now your cost basis is $99. So you continually do that and lower your risk in your overall portfolio. So there's a lot of different things that I implement into the portfolio to constantly try to reduce my risk to the downside. Because as we all know, when the market goes down, it is painful. But if you can add a lot of short deltas, you can mitigate a lot of that downside risk. And this is one of those things where you can add to a portfolio. This is a high risk strategy. It's not like doing a covered call. It's not like doing a iron condor where you have protection, you have limited risk. There are ways to build it out and make it, say, IRA appropriate. For instance, if I were to go in here and sell the at the money, which, we're right there at the 75.5. This is the at the money. So the short call is the one that you have to worry about, right? Because that's the one where you are the naked. The person buying this call from you can exercise their right to make you take that stock. So, and that would create a real short position, a real stock short position, not the synthetic position. But the way to mitigate some of that risk is when I've sold this call and I buy this put, so it's the same strike, we're doing the 75s, and I'm short the call, long the put. Oops, make this a one lot. And so we're doing an 80-cent debit on this. So, remember what I talked about, that's going to have to be subtracted from the strike price to get our break even. And one way to do it is to kind of look at this. It makes our break even 96.70. So it needs to go to 96.70 before we're breaking even on this. So that's not a great one to do, but this is one of the things I was talking about, the buying power effect. And this is how you would increase your return on capital by using this strategy rather than short selling the stock. You're only using $2,298, so let's say $2,300 in reduced buying power effect. If I were to go up here and just short sell 100 shares of Apple, which is the same thing as doing one contract in the options, because for every one contract that is equal to 100 shares of the underlying, you can see it's 4,800. So about half of the buying power effect. So, this is a good strategy to add rather than just selling the stock short. Plus, you don't have to go out there, seek out those shares. Apple is going to be a little bit easier, but there's other stocks out there that are a lot harder. And sometimes the brokerage firm will say, no, this is a non-marginable stock. So then you would have to go into the stock option chain to create that same position. But I don't understand why you really would, because the options, you can go so far out that it doesn't make it cost effective in my eyes, because you're using so much buying power effect. And why would I use all that buying power effect when I can do it with half, right? Woody's asking, is this recorded? Yes, this is being recorded. Unfortunately, because I had a snafu earlier, if you just joined us, I was showing the wrong screen, so it was a little bit wanky. Anyway, so moving on. Do you guys have any other stocks you guys want me to look at here? All right, so I'll start in with some of the ones I like as a short. I do like Apple as a short. If it comes up here and retests this 100 and fails, that's where I would like to short it. The other one, of course, I'm probably going to be picking the stocks everybody loves to get long, but Tesla is another one. Yeah, I'm hearing the new model that they came out with isn't very sexy, if you will, and a lot of people are not very happy with it. So Tesla could be in a bit of a conundrum with that, and they don't have very many other lines out there that they can kind of diversify with, and they don't have anything in the works, it doesn't seem. And at this valuation, Tesla is really overvalued. I mean, it's forward earnings for several years. They do get a lot of money in their carbon side of the because they're a green company, they get a lot of carbon credits, so they do make a lot of money that way, but that's not really sustainable for this type of valuation. They really need to start pushing some cars out there, and maybe even come out with a lot cheaper car so that the average American can really participate in that. So a couple of people are throwing them out. And I like them. I like the ones you guys are coming out with. So let's look at. Yeah, they do. I think he's trying to. Elon Musk is trying to change the whole electric grid out there. So you know, if he can power all of our houses, that would be one thing. But you know, that's a really long way off. All right. So Target. Let's look at Target. Target's been rallying pretty good, but you can see that this is in a bear market. You know, you could basically draw a trend line right down there, and it's stuck in a bear market trend. Probably would be a good time. This is usually the big indication that you're really entering a serious bear market trend. This is the 200-day moving average and the 50-day exponential moving average. So when those cross, that usually indicates that you're moving into the bear market and it's getting wider. So Target would be a good one, and I know that I've traded a lot of Target, so I know that they have a pretty tight bid ask. You know, it's after hours, it's a little bit wider than 10 cents, but I think usually you can get inside of that. As you can see on the put side, it's a little tighter. And this is the volume and open interest. There's quite a bit of volume and open interest in the March contract. One thing that I do always talk about in these webinars is one of the things I always look at is this current IV percent, and that's IV is implied volatility. With this strategy, the IV doesn't really come into being a major consideration. The reason why, because you're selling the call and you're buying the put, so those will offset. As implied volatility goes up, both of those premiums are going to inflate relatively at the same pace and will deflate as well. So it's not really going to affect you like it would in some of the other strategies that I do webinars on. So I'm not going to really talk a whole lot about implied volatility on this one because they offset each other. Now, another thing that I talk about in this, if you are going to do this in an IRA or something like that, that you can't have that short call in there, that naked short call. What you can do is when you sell this call, we're going to sell that call, we're going to buy this put, okay? We need to look at the deltas also. So let's go to the deltas. And we want to try and get this delta to be as close to, add up to be as close to 100 as we can, because 100 deltas, like you see here, is going to move dollar for dollar the way that the underlying is. So at 100 deltas, for every dollar, say Target goes down, our profit is going to increase by that dollar. Does that make sense? Ange is asking about theta decay. Yes, theta decay is always an important factor in here. These are going to decay, and you know, that's why I would like to get a little bit further out. I would not probably try to do that. I also want the time to be on my side to be right in this strategy. So I always default to the 45 days. It's really hard to predict anything, especially way out there. So I don't do a lot of trades out there. I do some, but theta decay is going to be a factor, and we do want this to move in our direction relatively, you know, soon. We don't want it ever to go against us. The same as if you were buying a stock, you don't want to buy it, have it go down immediately. But that is okay. So I want to sell the target there, and then I'm going to buy the puts here. Sorry, I pulled that up wrong on the options chain, and it creates the debit there. So this would be the synthetic short position, but if you're in an IRA, it's not going to allow you to do that. So what you can do is go up here and buy something pretty far out of the money, and say buy these here, these 85 strike, and that would make it appropriate for an IRA because you have limited your risk. It's not going to reduce your buying power by very much at all, if anything. Sorry, this is defaulting to 1. I want it to, so it's not going to reduce your buying power by that much, but it will make it appropriate. You're not reducing your risk either for that. I mean, for 20 ticks higher, it's not going to reduce your risk that much at all because you're probably not going to be holding on to it that long if it's going against you. Let me see. Let's do this. So 1. And then you would go in here, and to build this out, what I do is, you click on the sell on the call, the buy on the put. Yet when you go to buy on the put, you have to hold down the control button and then click on it. And then if you wanted to make it appropriate, you would want to buy that call there one time only, make sure everything's equal. And then that would make it appropriate. So that's limited your risk to the upside. Yeah, let's see if we can analyze this trade. Is this what you were asking about? So this is the same thing. If you were to do a short stock position, this is going to be your risk graph. Obviously, as it goes up, you're losing money, and as it goes down, you're making money. So the same thing would be as if I go to the trade page, do this, sell it short, and then we can analyze that trade, and it's the same profile. See that? So it's going to be the same profile, lockstep. Yeah, Nick, that with that last example where I bought this call here, I am protected to the upside if it jumped $20, and I'm no longer going to be risking anything above that. So anything above 85 or more, I'm not risking any more money when you create that, buy that long call in. Now, there are situations where, say for instance, you get the credit, you can spend that credit on the call. Don't spend all of the credit because that, is going to mess with your break even also. So usually when you're doing these right at the money, your break even is very close to where it's trading, and that's what you want to do. You want to try and get it within, within 25 to 50 cents of where it's trading to have your break even. Does that make sense? Ange is asking, how is it different than buying a put and selling a call spread? Well, yeah, that would be. You're buying a put and then selling a call spread. Yes. You just have to, what I'm trying to make you guys, the tighter in you buy those calls, the less risk you have to the upside, but you're also, reducing your break even. Your break even is going to be further away from where you're entering the trade. So it's going to, increase that break even. So you're going to be losing money already. Does that make sense? The tighter you come in. So to make it really act like a short stock position, also the tighter you come in, you're going to be reducing your deltas. So it's not going to perform the same way as a short stock position. So that's another reason why you pick out here, is because it's only a couple of deltas. That's not going to really affect you as much as if you reduced it by 20 deltas, let's say. Does that make sense? All right. And you're asking about how is it different than buying a put spread. A put spread isn't going to give you the same risk parameter. You're not going to get dollar for dollar on the downtick. So that is the difference between the put spread and this. This is going to have 100 deltas, where your put spread is probably only going to have, let's say, 10 or 15 deltas. So for every dollar the underlying goes down by 1, then it would only go down with a put spread by maybe 10 cents or so. This is going to be a dollar for dollar. So it is a much higher risk trade. And then how do you close the trade? Richard's asking. Very good question. Excuse me. I will usually, on the upside, if it goes up by, let's say 10% on me, I'm going to be out of that trade for a loss. I'm going to cut it at 10% on the upside. On the downside, I'm going to play around with it, to be quite honest. So I'm going to be looking for it to come down, and I'm going to pick an area where I think that it's going to go to, and then when it hits that area, that's where I'm going to get out. So I usually look at like the Fibonacci's, like I would have on Apple. So Apple, for instance, if it came up and tested this $100 area where I think it's going to, I would likely get out of that, on the 10%. If it came up to this, that'd be pretty close to a 10% rally if I got into it at about 100. And I would get out of it when it came down and tested this Fibonacci area, which is about a 50-50, which, when you're buying stocks, it's a 50-50 proposition as well on that, theoretically. So this would be more of a 50-50 type of proposition. You can do the same thing with Tesla, but my out on the risk side is usually going to be 10%. Does that make sense? Unless it's like a $5 stock or something like that. Like I was looking at, let's see, Seadrill or something like that, where they're really cheap, or U.S. Steel I was kind of looking at. Those are really beaten up. I would look at it a little bit differently on a much smaller stock that I'd probably take a little bit more risk on it. Does that answer your question? Bruce is asking, why are we doing this? Because I think it's very important to have a lot of different types of strategies available to you when you're managing your own portfolio. There's the idea of just buy and hold, especially in volatile or bear markets, isn't very conducive. Yeah, you can dollar cost average on the way down, but you're also losing money on the way down. And this is a way to take advantage of a bear market or a stock that is losing its luster, and to create some short deltas in your portfolio. Yeah, you are going to be limiting some of your upside potential on that, but the fact of the matter is stocks don't go up forever. It just doesn't happen. There are stocks out there that go down, and this is a way to take advantage of when a stock is no longer loved, that you can take advantage of it on the downside. Just like we saw in GoPro, everybody was talking up GoPro when it first came out, but at the end of the day, I just saw somebody come out with another type of GoPro where it's a stabilizer. So it has an automatic stabilizing thing in this. And if you guys have ever used a GoPro or seen some of these videos on GoPro, when they're off-road or they're skiing or whatever, it gets a little nauseating to watch because it's constantly moving around. Well, this camera has a way to, I think it's like a gyroscope in there kind of, and it totally smooths out all of that gyration that you usually see in the video. So, that could be the end of GoPro. Why would you have a big old chunky camera on your helmet when you could have this more streamlined camera on there that takes out all of the movement. So there's always somebody trying to step up to the plate and knock you off of your pedestal, just like what happened with Polaroid. You know, I mean, everybody had a Polaroid where you'd shake the picture out. Well, where are they today? They're bankrupt. So, you know, there's somebody always going to come up, and there's always going to be and nobody ever thought Polaroid was ever going to go down. You know, so they do have chinks in their armor, and you can see Tesla is got a pretty big chink in its armor. Now, do I think that this is the perfect place to test or to short sell Tesla? No, I think I would definitely wait for a bounce in this, because it is down here, tweezer bottoms, you know, that could act as support, or is going to act as a pretty major support, and probably want to bounce off here. I'm short Tesla. I've been short Tesla for a little while, but if I get much of a rally up here, I'm going to probably get out of it. But, you know, I don't think Tesla is sustainable with what it's got right now. All right, so you know, CMG, we might be a little bit behind the curve on this. So, you know, they got beat up because they had the issues with their food, and people were getting sick, you know, and they had E. coli, and really fell off the lines. Basically, you could walk into any CMG at the beginning of the year and basically through the summer, and there were long lines. Well, after this all came out, you could walk up there and rip through the line. There was nobody in there. But I'm starting to hear that people are starting to go back in there and, you know, testing the water. So it might not also be the good time for that. You know, if you don't really like it, you think that there's something else in the air, it is stuck in this, I don't know if I have my right, no, I don't have it on there. You know, it is in a downtrend for sure. So why isn't that working? Oh, wait. All right. This is what I wanted to do. So, you know, you can see that it's kind of broken through a little bit, but it did settle below that downtrend there. So I'd have to look at that on Monday, and that might not be a bad one. If this opens up below here, that could definitely go down to test this area here. The other aspect is it is a $500 stock, so you know you have to have a lot of margin in there to be able to do that. Just like if you were going to buy 100 shares of Chipotle, then you would have to have a lot of money in there. But I don't know if that's for everybody. But if you did have a bias on that, then this would definitely be a good one, because it's really just the margin that you're taking out, right? So there we go. I would look at that. So double check your deltas, make sure I got my deltas right. So 55 and 45. So I've got 100 deltas short on this. And then make sure you are not doing 1,000 shares. We're only doing 100, unless you do 1,000 shares too. So to each his own. And confirm and send. You can see that's going to take $11,700 in buying power effect. Again, if you were to go and just short sell Chipotle, you're going to be looking at twice that, so 22,000. You can see. So that, you know, you're asking why would we do this type of scenario? Well, it's a lot less buying power effect. We're bearish. You know, it's hard to get through to some investors that you know, they don't have a problem going out and buying a stock and holding on to it. You know, they know it can go to zero. Same thing with shorting a stock. You know, you can short it because, you know, yeah, it could go to infinity, but what's the likelihood that, you know, Johnson & Johnson is going to go to $1,000 a share? Well, it's probably as likely as it's going to go down too. So, it's a 50-50 proposition in that regard. But if you are completely long stocks, then you are beholden to the movement of the overall equities. So you're riding the wave rather than taking control. Does that make sense? Can you use on demand and think back to practice options trading? I'm not very familiar with those. But yeah, you can, TOS has simulated trading. You can do that and go in there and play around with these different types of strategies to do it. Yeah, Bruce is saying, yeah, a bear call spread keeps your downside controlled and you get paid. Yes, you do. Obviously, there's a lot of different ways that you can take advantage of the bear market or bearish assumption. This is a very aggressive bearish assumption type of strategy, and it's not for everybody. But the fact of the matter is, you need to know that this is out there and that this is in your quiver of tools that you can use to take advantage of different situations. This is a very aggressive strategy. Bruce, you're talking about the call spreads. I love call spreads and do short call spreads all the time. Absolutely. But with that, if I were to do a call spread, let's say we were going to do a call spread in CMG, and I'm going to sell the 36 delta and then buy the 26 delta, so the 500s. Yes, you're getting a credit of $4.50. You only have $15 in, $15 in risk on that. Well, you collected $4.50, which this is a perfect example of relatively perfect. Not $5 would be really perfect, but that I talk about in some of the webinars on doing short call spreads. I want to collect a third the width of the strikes. $15, I'd want to collect around $5, so this would kind of fit in there, finagle it a little bit. And yes, I would, if CMG went down, be able to collect this whole $4.50. But for every dollar that CMG goes down, my deltas are only going to go down by, or I'm only short 7 deltas, right? Because I'm short 36 deltas and then I'm long 29 deltas. So I'm only short those 7 deltas. So on a portfolio where you have 10 different stocks that you're long, you're long thousands and thousands of deltas. So this is 7 short deltas against all of that is a drop in the bucket on anything that moves down. This is an aggressive strategy that you are going to be able to have, 100 short deltas for every 1 lot that you do. If you did a 10 lot, then you'd be short 1,000 deltas. Does that make sense? Does that make sense to everybody? I understand that, this is an aggressive strategy, and it's not one that I implement every day, but it is one that needs to be known about and implemented, especially if you have a portfolio of $250,000 worth of stock. Stock market goes down 10%, your portfolio has gone down easily by 10%, if not more. So this is an aggressive strategy. This is a way to protect a portfolio, and you could do this with, if you are very tech heavy, you could do that same thing in the Qs. Somebody mentioned about doing ETFs. Absolutely, you could do this with the Qs as well. And if you are tech heavy in your portfolio, I would definitely go to the Qs just to kind of protect that overall portfolio there. And again, I do have a position in the Qs, as you can tell. This is my short call spread that I think I just did this today, and I talked about it in the market commentary. So, I implement these types of strategies just like Bruce was talking about. Also, this is a very aggressive strategy where you have a really biased opinion on that underlying or that overall indice, that equity setup. So, to each his own. This is one that I implement. It is rare. I'll admit that I will go and short sell stock, but it is very rare that I go and just buy long stock. The reason why is because I think I think the long stock is a big margin hog. So I don't know why I would buy stock when I can use options and simulate that same type of position. Does that make sense to everybody? So I look at them. I look at short selling the same as I look as buying a stock out, going out and buying Walmart or something. I would look at going out and buying 100 shares of Walmart, just about the same risk as going out there and short selling something along those lines as well, because what goes up does come down. So, and especially when it really gets over pumped, like I think Tesla's over pumped. Yeah, they have a lot of things in the pipe. But those are also pipe dreams as far as I'm concerned at this point. There's nothing come to fruition, and all of that's priced in that it is going to succeed, and I just don't know that it is. So that Tesla, those kind of things are something that I would look to short. I even looked at shorting Fitbit. As you can see, I have it's up here at the top, but I was looking to short Fitbit, but the spreads in there are just too wide. And GoPro's kind of the same thing, and it's really gotten beat up. So it's, I don't know if GoPro can go much lower. They do have a lot of assets, so that move is pretty much done, and I wouldn't want to sell that. The other thing is, a lot of people were talking about, getting short Twitter. The risk in my eyes on Twitter is to the upside. So this is another one I wouldn't short. It's kind of flattened out. Basically, the board of directors, they don't have a CEO, they have no guidance, but Twitter is extremely popular. As soon as they get in there, they make one crazy announcement that they pick up somebody as a CEO or something like that, it's going to go to the moon. So this is definitely not one that I would look to do that with. Something I would be much more comfortable doing it in something like Tesla, because I don't think Tesla has anything major coming out. The one nice thing, I don't know if I mentioned this, that doing this strategy rather than short selling is when you have the dividend on a stock. Tesla doesn't pay a dividend, but for instance, Johnson & Johnson pays a dividend. You don't have to pay that dividend when you're doing it with options, as opposed to if you short sell a stock, you have to pay out that dividend. Does that make sense? When I say 10% to get myself out, I mean a 10% move in the underlying. And usually when I'm doing something with this strategy, it's usually 50 to 100. I'm usually looking at like $100 stock. Usually when I'm thinking that, the further down I go, the more I increase that percentage. That So if it's like a $50 stock, I'll probably increase it by, maybe to 15 or 20% increase. And if it's a $5 stock, it's probably going to be really closer to a 30 to 50% increase. So it's kind of scalable by how much, I really kind of look at it, how much am I willing to risk on this strategy. The same thing if I were to go out and buy a stock. It's, at some point I'm going to be looking at cutting my losses on the downside, right? And it's not always going to be 10%, because on a $5 stock, 10% is like 50 cents, right? So I'd probably look at increasing that to maybe 50%, so $2.50. Whereas with a $100 stock, I would definitely not want to risk 50% to ride this out to go to $150, or to even, I wouldn't even hold Johnson & Johnson if it was looking to go down to 50, right? I'd probably, if I was buying Johnson & Johnson today, a 10% move down to 90 would be somewhere where I would be seriously considering getting out of this. Other than that, that's a major support area right here. That's probably where I would be looking to get out, or have a very itchy trigger finger. Does that make sense? So really with this strategy, the takeaway is it's not really what my risk is that I'm willing to take on it. It's what you guys want to risk, right? So look at it that way, do some soul searching and say, how much money am I willing to risk on this strategy, and how much am I comfortable with, right? Same as if you were to do it with, same thing as if you were going to do it with a stock. I hope that when you guys are looking at stocks, that when you're looking at stocks, you definitely have your risk thought out before you get into it. Like, okay, well, if Johnson & Johnson goes down to 90, I'm out. I don't care what happens, I'm out. I'm going to be retooling, dying, and thinking about something else. And you might even say, if you bought it up here because it's near the high, if it comes back down, to say 87 or something like that, or you draw the Fibonacci lines and say, hey, that's where the Fibonacci is saying I get out, that's where I'm going to get out if it goes below that. Does that make sense to everybody? So what my risk tolerance is probably completely different than what your guys' risk tolerance is, because for one, I've been doing this for several years, and it's probably much different than what yours is. Does that make sense to everybody there? Is Baidu a candidate? Yeah, I'll do Baidu real quick. We're starting to run over. I didn't look at Baidu. I was looking at Baba, and I think, you know what? Baidu is a pretty good candidate right here. It just crossed, which to me, that's an indication of it turning into a bear market. So I would say if it comes up and doesn't pop through this little area right here, where it's kind of topped out a couple of times, that would be where I would look to go in to short it. So that's what I do also, is kind of, all right, I'm not always going to do it today unless I hear some kind of news and I want to, I've seen the buy the rumors and then you sell the fact kind of thing. That's a different situation. Otherwise, I'm kind of looking at these when I'm looking at them. Hey, this is coming up against resistance. It's failed. That's where I'm going to put it in. John's asking, are the Qs a short at this price? No. So when I'm looking at the Qs, I'm kind of looking at, let me see if I can find my NASDAQ chart here. All right, so I'll just go to this one. This is the E-mini S&Ps, but the NASDAQ. So I've been talking about this in the daily market commentaries, is, this has been where it's starting to find a little bit of comfort right here against this value area low, if you will. But I do see the NASDAQ wanting to come up and test this point of control. And that's where the most time and volume has been spent. So that's the comfort zone. And I think that the bulls are going to try and push it up against that. I do see, because I think that the overall economies globally aren't doing very well, a retest of that and then a fall off to retest these down here and go even maybe further. So we'll have to see with what the Bank of Japan's doing by going negative with interest rates. Everybody wants the stock market to go up, so it'll be interesting to see it. Keep your eye on crude oil, because crude oil has really been the leading indicator as to what the overall markets are going to do, because that is an indication as to how well the economy is doing. It doesn't look like anybody in the Middle East is going to cut production. They want to run us out of the Balkan oil fields, and I think I saw somewhere Exxon, for the first time in a decade, lost money. So they're obviously committed to trying to drive us out of oil for right now, or at least oil exploration. They know that we have a lot of oil, so they don't want us to get to it, because the more we can get to it, the better we're going to streamline that process and drive those prices lower. So be wary of oil exploration related stocks right now. So that's a pretty scary place. All right. So I wouldn't say the Qs are a short right now, but I would be looking to short it up here if it comes up and starts failing there. That's how I would look at it. Does that make sense? Because right now, this is how you can tell the bulls are losing right now, because this is where everybody's got their happy medium. Above here, bulls are in control. Below here, the bears are in control. Does anybody else have any last second questions? All right, great. Hey, I want to thank you guys all. One thing we do have is, you can sign up, check in your chat box there. There should be a link that you guys can sign up for. Richard, I'll run over that real quick after I get through this little spiel. If you guys want to stick around, I can show you how to build some of those charts out. So anyway, options premium membership trial for $7 for this month. You get the daily market commentaries, which I basically go over the thought process. I go over the charts and what I'm seeing in those, and talk about global economic and geopolitical stuff. And they were like 10-minute videos each day. I'm throwing those out there. And now that I've got my computer fixed, it's getting out there a lot quicker. So you also get the top options trading lessons videos, which are like 10-15 minutes on each of these different types of option strategies that you can implement in your portfolios, but they're a lot denser. So I go over it a little bit quicker. I don't go into as much details as I do in these live trading workshops. Plus, these trading workshops, you have the opportunity to have a little bit back and forth and talk about what you guys are looking at, and hopefully I can help you out with that too. I hope that's really helpful. Adds a better dimension in my eyes. But check out the chat window there. You can hit that link to get this offer. And finally, later webinars, we're going to be drilling down on other option components and trade some options, trades I find and where I find them appropriate. And like I said, this is the link that you should find in your chat box window there. And if you have any questions or want to contact us, if you guys have an issue with your portfolio, there's a trade that's going against you, you're getting tested on something, and you want to know what I would do. I can't tell you what I think you would do or you should do, but I can tell you what I would do in your situation. You have to see if that's appropriate for you. You have to do a little soul searching there, but I can, at least tell you what I would do. I'm not allowed to tell you what you should do. Does that make sense? I mean, I don't know you guys' risk parameters. I don't know what's in your portfolio. So I can just tell you what I would do. And you can email us at trading@protraderstrategies.com. I'm really good about getting back to you guys on email. So I'd love to help you out if I can. The other thing is you guys can follow me on Twitter at wolfmansblog.com. All right. So that's all I got for you guys today. If you can't take that, take it easy. All right. So I'll go over a couple of you guys' questions real quick. Fred, do you do live trading? Yes, I do. All my I talk about those in the daily market commentaries and stuff like that. I don't like to do the live trading platform up here while I'm doing this, just in case I screw something up and, like it was defaulting to 10 or whatever. I'm not thinking as clearly when I'm doing these webinars, because I'm trying to think about the next step in the process and teaching rather than, exactly what I'm clicking on. So I get a little nervous about that. Someday maybe I'll be able to step up to that and just fire it away, but I'm not quite there yet, Fred. Sorry. Does that make sense?